Hello, everyone, and welcome to the One Finance World 2026 Global Financial Conference. I'm Henning Stein. I'm genuinely delighted today because I'm joined by an investor I deeply respect, Stephen Gray, the managing principal and founder of Gray Value Management. Stephen, I told you many times, but I truly, value every chance we get to exchange ideas. And in an industry, often dominated by, I would say, an echo chamber at Wall Street, it's always interesting to hear your views. And I always walk away from these conversations with a very fresh perspective and new learnings that actually challenge my own thinking. So, as an investor, for our audience, Stephen brings a unique blend of geopolitical intelligence honed during his time at Albright Capital and a fundamental research process that is practically a lost art. Stephen, it is a pleasure to have you back.
Oh, thank you for inviting me back, and I really appreciate the introduction. I'm very flattered. I think that what you're doing here is very interesting, and I'm happy to participate.
Thank you. And when we first spoke, you showed me immediately your performance, which I found interesting because it's actually a good way to start the conversation. And I'm very outcome oriented myself, so maybe I think the best way to stage this is to have a look at your approach, which is a deep conviction, of course, approach. And I therefore ask you to bring along a snapshot of that trailing performance, which is really, really phenomenal from your recent partner letter. If you could maybe
Uh,
pull it up.
Certainly, let me see if I can do a little quick screen share here. Okay. So there you can see the monthly performance, I think,
Yes.
and then the performance by interval. We had a pretty decent year last year, up 28.7% net, about 36% gross, up about 49% over the last 3 years, 70% over the last five, over 100 the last seven. So it's been a pretty decent stretch.
Yeah, I mean, if you look at these numbers, and at the beginning, they were not so great when you started out, right? So maybe you want to talk about that. What turned that around?
Yeah. No, I mean you're right to point that out. I mean it's when we launched. I honestly, I'm sure looking at the numbers, it looks like we were going through our partner's capital with a flamethrower, right? But
Right.
we focus on the contrarian and the obscure. That's where we look for that sort of golden combination of a substantial margin of safety as well as a significant upside. And you're only going to find that, to our experience, if you're looking in things that are either contrarian or obscure. That's where you get that extreme mispricing. And part of the problem is when you launch a fund with cash, cash has no positive volatility. So you're allocating to these things that, because of the nature of them, these things that are contrarian or obscure, they don't tend to correct very quickly. And so as we're
And can you
allocating,
say to for our audience, I can't see it on my screen. Maybe I need to move this a little bit. But the first year when you started, which year was that? Was
let's
that
see,
2008, 9, or
can you see it a little better now?
uh,
2014, 2015.
2015? That's when you started.
Yeah.
Okay, okay.
And so
That-
all of this stuff is initially training against us, but of course, by the end of 2016, and by the way, everything we invest in is liquid and publicly traded, so it's all mark to market. There's no mark to myth in our world. Um,
right, and it
by
turned
the
around after that was just the first year, which was negative, and then
by yeah, by the end of the second year, out of about 2 dozen positions, over 90% of them were in the black, which I
right,
think is a pretty decent hit ratio. And that's one we've maintained over time. The centerpiece of our investment strategy is loss avoidance more than anything
yeah.
else, protecting our ability to compound.
I mean, that's what I sometimes find a bit strange when people talk about value investing, and there is value apparently, but it doesn't show up in terms of performance. And in your case, it showed up after the first year and consistently so. So that's why partners stay the course, I guess. And I mean, in the market, that's I think often driven by momentum and growth at any cost. I mean, these figures really suggests there is a massive premium for those willing to do manual labor of deep value investing. Otherwise, I could just go for an ETF, investing in the entire market. And maybe for our viewers seeing these results for the first time, how do you explain that this isn't just a hot hand in a volatile market, but really the direct result? I think you mentioned 400-hour research process that goes into this.
I think it's a very important and fair question. I mean, we run a very concentrated unlevered portfolio, 15 to 20 positions. Okay, so that's the framework. The composition of our portfolio bears very little resemblance to the broader market. If you look at last year, for example, we owned none of the Mag 7 and only one stock in the S&P 100. And we deliver alpha because, objectively speaking, we have almost nothing in common with beta. We don't use any outside research or algorithms. So, I mean, fundamentally, if our process isn't driving our performance, what is?
Right. I mean, you in essence, your quant goes into the research process, but then, I often find that it's almost quantamental, right? I mean, when we look at research, we look at data usually, and then ultimately, it's not quant investing because it's not done by a computer; it's done by you, right? Doing all that research.
Yeah, a lot of the data is quantitative. Of course, all the financial data is quantitative, but it's all forced through a qualitative process in terms of the analysis.
Right, right. And I think no, we live in an era of instant data. So I always keep saying that. And now with AI, of course, it's even more accessible. And many investors rely on high frequency signals and these kind of AI-driven summaries. And a lot of them are slop. I call it slop because you can immediately see it. It's
It
done.
is slop.
Yeah. And even heard now companies actually setting out KPIs for employees to use AI, which leads to a lot of corporate slop because they just create useless PowerPoint slides to
Yes.
meet those KPIs. I mean, you have taken a different path. I would say the opposite path here, right? Famously reading hundreds of pages of filings, spending significant time on a single investment case. So to me, this suggests that I think the real alpha today is not found in speed, but really in patience to outread the market. But patience doesn't mean you have to wait for years to see the returns, right? And in a world, obsessed with these immediate results, how do you, maybe that's the question, maintain actually the discipline then to stay curious about a single company for longer? And at what point do you say enough is enough? I give up my thesis. This doesn't work. And at what time do you think, okay, this is now the truth is finally revealing itself?
I think another interesting question that doesn't have, I don't know, a very narrow answer. I mean, the first part of your question speaks to a key factor, I think, that is overlooked, which is curiosity. And discipline is absolutely key, but curiosity is really important. You're not going to be very good at fundamental analysis if you're not interested in what you're analyzing. But it has to be a rigorous, questioning, applied curiosity. I view skepticism as a kind of weaponized curiosity. Maintaining a vigilant skepticism is critical. We never fire and forget. I'll give you an example. I wrote a piece for the Financial Times back in August of 2022 about a big position that was very profitable for us.
Right.
The problem was we started noticing a growing disparity between the GAAP results and the non-GAAP results. And though it was very profitable for us, we eventually concluded that the performance benchmarks management was trumpeting were significantly misleading. And so we sold the shares. And of course, the price kept rising. So there's the wisdom of the market proving us wrong, right?
Right.
But soon thereafter, they announced a $600 million debt raise. We naturally assumed that the major Wall Street firms that underwrote that debt did their due diligence. They were certainly privy to non-public information that we had no access to, but the numbers still didn't make sense to us. About a month after the debt was issued, they slashed their forecast by two-thirds, fired the CEO, and a year later, they were bankrupt. The stock went
Right.
to zero. So the truth that you referenced is elusive, and it's frequently a moving target. Because of that, you should never, ever, ever let your guard down. We probably ask ourselves, what are we missing 50 times a day? Voltaire said that uncertainty is an uncomfortable position, but certainty is an absurd one. You need to
Right.
develop a measure of confidence to take action, but that confidence should require significant time and effort to develop. I mean, I guess the way I would summarize it is, I mean, confidence is a necessity, but in investing at least, certainty is suicidal.
Right, right. I mean, and then of course you also use macro data, I would assume, right? And for me personally, sometimes it's interesting if I watch Bloomberg and I see the analysts in Wall Street and major asset managers, they then at periods become so hyper focused on what's going on in that moment. Last year around this time, it was the tariff, and everyone became an expert in the details of all of this. And now it's the street of homos and everything to do with oil and I sometimes wonder, it's like, is it not better to just ignore all of this and just really focus on the micro part and understanding the companies, and then really have only the big picture in mind when it comes to macro? Let's say big things like debt could be a long-term story here, right? But certainly not a one-off tariff that then is politically, negotiated. And I knew that it's going to happen, right? I knew it's going to be a non-story at some point. But people were so
Mhm.
at the point that like nothing else was discussed than tariffs. So
Yeah.
how do you see that? How do you distinguish between macro topics that you think are, essential for your investment thesis and those that are just noise?
I think, fundamentally, our inability to predict the future doesn't mean that it's safe or smart to ignore the present. I think that's a really important distinction. I mean, we have no ability to predict the future of the economy, the market, politics, but with some effort, we can at least get a good grasp of where we are now. And if you're an investor, that's your inescapable starting point anyway, right?
Right,
I mean, in my view, it's best not to try to predict the inherently unpredictable.
right.
Did any of the most respected political and macro analysts predict what was happening in the Strait of Hormuz uh, 2 years ago, a year ago, 6 months
Yeah,
ago? Did anybody predict COVID? You look at our home market, the US, current valuations may not be telling us US stocks are officially in a bubble, whatever that means, but they
right,
are telling us that we have every reason to expect lower returns going forward. And so if
right,
you want to manage your positions and your portfolio for what you cannot predict or control, that's the
right.
key.
Yeah, I listened to the leading portfolio manager AQR. He basically said the next 10 years returns will be less. And I want to say, can you really project that as a capital market assumption? But in a sense, you need that market capital assumption in order to invest and to find your investment thesis. But I think if you're right, if you over focus on too many things that could happen, you freeze, right? You don't invest anymore. You sit on your cash, and there this leads me to my question. Actually, when I looked at what you published, I noticed in late 2025, so last year, you made headlines stating that cash was your favorite investment choice. And I think at the time you argued it's an environment on inflated valuations, and that cash is just it's not just a placeholder, right? But really a tactical option here, almost like a sleep factor, I think you call it, that turns into a weapon when the rest of the market is eventually selling. And now, as we move through 2026, do you still view cash as your primary fortress, or have you changed that and you're deploying now more vigorously capital in specific sectors?
Well, we're in the market, but I think for a lot of your audience, particularly investors who are investing on their own, I mean, the thing to keep in mind that in the current environment, I think investment success, and to an extent, I think investment survival will be dictated by what you avoid. What's the one thing that every individual investor, regardless of their experience level, has in common with Warren Buffett? Neither one of them ever has anyone call them and say, "We're not paying you to be in cash." The most
Right,
mispriced element of investing today is the optionality of cash. There's no investment advantage more powerful than having cash when others don't. How much of Warren, you think about it, I mean, how much of Warren Buffett's long-term returns have been powered by investments he made when the market had plummeted?
right,
There's always opportunities in individual names. I think that what's most important for your investors to focus on is, resilience in terms of looking at individual stocks, companies with strong balance sheets, resilient cash flows, and that sort of thing. But if you look at allocating cash now, and again, this is an observation, the usual disclaimer, this is not investment advice. The thing is, right now, that in addition to the optionality value, cash is offering a pretty good return, specifically the short end of the yield curve. If you're an investor, an individual investor in the US right now, FDIC insured CDs with a 3-month maturity are paying close to a 4% yield. And
Right.
again, they're insured. So the long-term return on equities is about 10% annually. But with US equity valuations near all-time highs, investors have every reason to expect returns, let's say, going forward to be much lower. Well, I'll be generous and say maybe 7% annualized. That
Right.
means that federally insured short-term CDs are now offering over half that return with none of the risk. And because they mature quickly, they preserve that all-important optionality. If interest rates go up, if they suddenly leap, you'll be able to roll them over into a higher yield. And if the stock market buckles, you'll be in a position to rotate into equities offering more attractive returns than they are now. So that inverted yield curve is incenting you to not take on more risk. I think that it doesn't make sense to be reaching further out into the yield curve or lower into credit quality right now,
But
especially
when you say
banks.
CDs, I'm from Europe. Short-term CDs, are they're unlimited in terms of how much you can invest in those, or they're pretty limited in terms of the
Uh,
amount
In
saved?
terms of if you're a retail investor, there's almost no limit. I mean, there's a $250,000 insurance threshold for each investor per institution. So let's say if you had $500,000 to invest, you'd split it and invest it into two different banks to stay below the insurance threshold. But you
Okay.
would have to have a tremendous amount of money to not be able to take advantage of that. But you can look at short-term treasuries as well. But there really is no reason to reach out into the yield curve for more return. It kind
And
of
then
reminds
they're
me
hedged,
of,
they're inflation hedged as well. Sometimes there are versions of that, and I think they have limits in terms of how much you can go into those, right?
but you don't, in a lot of ways, you don't need the inflation hedge because again, you're getting a higher return for investing over a shorter period of time. If inflation spikes and rates go up, well, these mature very quickly, and so you'll have your cash to reinvest.
Right.
And so that's something that every investor can do that's available to them and is almost foolproof.
So for you, cash is not equals cash. Cash also other instruments like short-term CDs. Would you also include gold in that bucket, or is that more a risk asset you almost regard as separate as a commodity, not as cash?
Um,
Well,
it,
say, oh, that's the real cash. That's the real money, right? It's not fiat money.
well, it depends on how you invest in gold. We have significant exposure to gold that I began building about 4 years ago.
Right.
But I was looking for exposure where we would be able to catch any kind of upside move in gold prices, but also effectively get paid to wait. And so essentially, what we were looking for was a gold miner that didn't forward sell their production so that they would benefit from rising prices and had a long policy of issuing dividends that reflected a lot of the gain that they saw in those sales. And so basically, what we were looking for is we wanted to benefit from an increase in gold prices, but we wanted that insurance policy to be one that paid us premiums.
Right.
And we invested in a gold miner that fit that profile, as well as some other important criteria, including mining gold in safe, politically stable locations where you're not running
Right.
confiscation risk and things like that. And there was one company that fit that description, and we created significant exposure there. So we actually, what's the problem with gold? It doesn't offer you a yield unless you invest in a gold miner, which offers you a yield.
Right. And to very attractive PEs. I mean, if you look at tech, it's sometimes way beyond 20, right? And here we're talking about 7, 8 sometimes. And I look at that, it's like, okay, these are cash machines with that kind of gold price. Even if it drops back to 4,000, they're still way above their cost, cost that the cost they face. So very attractive. But as you say, you got to be very selective and do deep research, right? Because of the geopolitical risk there.
Now, we did a tremendous amount of research, and of course, for a period we looked wrong. But even in that, when with the dividend yield, uh, we were paid to be wrong. We were paid to wait. We were getting a decent
Right.
yield all along, and so you didn't have that carry cost. It was actually paying you.
Right.
Again, sort of along the lines of an insurance policy that pays you a premium.
Right. And what do you think about gold ETFs, for example? Would you stay away from those because that's or would you then go in physical? I mean, you already said you prefer miners, right? Which I would agree with. But if you then have the choice between physical and ETFs, would you make a difference there?
Again, I think the yield of the miner, the producer, the yield makes a big difference.
Right.
The problem is, I mean, there's no fundamental value to gold. You can come up with a valuation of a miner that's dependent upon the value of gold, but there is, for me to say that gold is, you know, inexpensive or expensive at this point. I mean, I can look at the price chart and say it cost a lot more than it did, but what it's intrinsically worth is always up for debate. And so to say, well, okay, would I invest in a gold? Under what circumstances would I invest in a gold ETF or a gold miner? There are certain when you're dealing with commodities or investment opportunities where you can't get a strong sense of an intrinsic worth, they don't necessarily generate cash flow, then you have to be, in my experience, operating at extremes is the only place to be safe.
Right.
You want to be, we were willing to buy because the price seemed remarkably low given the risk horizon, and
Right.
that's why we bought. But
That's interesting. I remember Alan Greenspan once said that the intrinsic worth or value of gold is actually the fact that virtually every central bank in the world holds it. Otherwise, they wouldn't do that, right? But it's based on their belief, of course, and the trust in that asset class. So
you
I
bring
think
you
both
bring
of
up an
you are
important
correct in a
point.
way, right? I mean,
Yeah, that's an important point, and that was a factor in our analysis. I mean, the central banks have been accumulating gold for a long time, and it's only relatively recently that people noticed and started talking about it.
right,
But that was something that you saw. I mean, it's been going on for years, and so if you were looking and following it, and you can always listen, they can sell as easily as they can buy. I mean, you can see relatively recently Turkey was selling some of their gold inventory in order to prop up the Turkish lira.
that's
But
short term. Yeah, yeah,
yeah,
that's true.
yeah, but that's a short-term activity. And over the long term, I mean, I don't see the amount of faith and trust in fiat currencies increasing.
Right. Yeah, and I looked at the numbers. It really started way earlier after the financial crisis, in fact, and not so recent as everyone is saying, because there are a lot of commentators say, "Oh, this is all about Russia." That the Chinese got scared that Brussels would freeze Russian money, U.S. dollar denominated money, and then we need to build now a hedge by buying gold. I think that process started way before that, but.
Yeah, access to the SWIFT system.
Yeah, yeah. And you can virtually see now a lot of entities building vaults around key geographic assets like the Middle East to then be paid in gold for oil, right, instead of dollars. So that is an indicator that something is shifting there. Maybe an indicator. I don't know. It could be reversed if everything is fine in the world tomorrow. But I think history shows that there's this tension going on, and I think I think gold has still way up potential here, but that's my personal view. I mean, might be completely wrong on that.
I would not be surprised if gold
Right.
continued to appreciate. I mean, if you, again, you kind of flip the question around and say, well, are the governments, the major governments, particularly in the developed economies, are they seeming to exhibit more or less fiscal discipline?
Yeah. Yeah. Yeah.
They're not being very conservative or careful at the moment. And if you just follow the chain of events, the likely chain of events, and think in terms of cause and effect, I you know I don't see the dollar becoming more reliable as a store of value going
Right.
forward. I understand the appeal of our debt markets and the depth of them being a key strategic advantage when big overseas investors need to move a lot of capital around, pension funds, endowments, and sovereign funds. They can go into the treasury market and park that money without moving the price much going in or going out. But I think that eventually the fact that the United States, by an overwhelming margin, has the largest debt market in the world is going to become a disadvantage.
Right, right. Yeah, yeah.
I think one of the things that I was thinking about in getting on the call, I mean, it's people are always talking about, our debt to GDP ratio. And yes, it's high. I mean, it's over the last 50 years, the average has been about 51%, and we're now at about 124%. And our national debt now is about 39 trillion, a little over 39 trillion. But you don't pay debt with GDP.
Exactly.
You
That's
pay debt,
exactly the point. Yeah.
you
I
pay debt
always
with
say that.
revenue. And
Yeah,
if you think
exactly.
about
And
it,
I
so
always look at this from, yeah, just compare it with the wealth that sits in the US. I don't even know the number on the top of my head, but the asset management industry in itself is 150 trillion just sitting there in assets, right? That's
yeah.
150 trillion, right? So of course, you're not nationalizing that money to pay your debt, but you have to look at that in relatively and compare that to Africa or other where you don't have that kind of wealth, right?
And
That's
it's
a
again, you're right. I don't think that's going to be nationalized. I think we're going to continue to pay our debt with our revenue. And I mean, last year, our federal revenue in the US was about 5.3 trillion. The
right.
cost to service our debt is now about 1 trillion.
Yeah.
So 20% of our federal revenue now we're paying just to service the debt. That's the number. Those are the two numbers that investors should be focusing on. Debt to GDP is much less relevant
Yeah,
than,
it's like I mean, Brazil is a little bit different. Brazil has a lower debt to GDP, but their debt servicing is very high, and that's why you have a little bit mistrust in terms of investors going into Brazil. And they're really struggling with this, while the US is still doing fine, right? Even considering this whole US dollar debasement, talk, I don't fully buy into this because I don't see that in the long term. Looking at the DXY, it's still quite
Mhm.
stable, right? And if compared to the euro, for example, nothing changed still since they introduced the euro. So I think you have to look at that a little bit in relative to other currencies to then come to a conclusion. But of course, if you compare it one to gold, you see a big devaluation in the US dollar. It's clear.
Yeah, exactly. It all depends on what are you comparing it to. I mean, you look
Exactly.
at so many different commodities, you can see how that, you can look at the price action, but then you have to think, okay, how much of the price action is a function of a decline in the currency that commodity is priced in?
Right. And your time at Albright Capital, that was very interesting because it gave you this front row seat to how global policy shapes markets, right? And today we navigate what the CIO, in fact, of UBS, Mark Heffele, called the 5 Ds. And it's demographics, it's deglobalization, it's decarbonization, digitalization, and debt, which we already discussed. So, and we've seen that playing out recently, of course, with the Middle East again and the ongoing fragmentation, I would say, of global trade. But how much of your research today is really focused on that macro geopolitical chessboard versus the micro fundamentals? Do you combine that? Can an investor truly be, let's say, a value seeker today without being also a political analyst, right?
I think that the more you have to question about the macro environment, the more volatility you witness, the more, I mean, I think we're living at a time in many ways of radical uncertainty. And the
Right.
more uncertain the macro environment, that landscape becomes, the more you want that reflected in the choices you make at a micro level. For example, I mentioned earlier briefly, this is not a time to be invested in companies, I think, that are highly leveraged.
Right.
I would not want to be invested in a company that is highly leveraged and is facing debt maturities, debt that will have to be refinanced soon. I wouldn't want to be investing in speculative or unproven financial or business models.
Right.
And again, as somebody, I'm not looking at this through the lens of a venture capital investor. I'm looking at it through the lens of an investor who prioritizes preservation of capital over
Right.
everything else. I mean, I understand if you're a venture capital investor, you're always investing in a business that has no, it generally has no cash flow, it's a very, very early stage. But as far as
Right.
preservation of capital and generating attractive long-term returns in
Right.
the markets of, mature companies that are publicly traded, I think that everything it's sort of what we were talking about a little bit before. I mean, I don't know what the future brings, but I can see what the present is offering and the circumstances. And based on these circumstances, you want to be investing in companies that exhibit significant financial resilience.
Right. And you think that is really has changed a lot. I mean, it's also relative, right? You say time of radical uncertainty. I would agree from just looking at the headlines, but then if I look back in the 1970s, it was even more extreme, I guess. I wasn't there yet as an investor, but I can look it up in the headlines, right? In the news, we had Nixon dropping the gold standard. We had lots
Hmm.
of wars and I think inflation was like double digits. So, and then I think, when you say that, you probably compare it more with the post 1990 period, which was pretty calm under Clinton and then also the early 2000s, right? There were, with the exception, of course, of the great financial crisis. But this where we say, why is this now a time of radical uncertainty and it wasn't 10 years ago?
Well, I think in some respects, we can look at some of the actions going on, and I think that you can argue that, for example, some of the decisions that are being made in this country, that have been made recently, are not even in our own economic or financial interests. And
Right,
how how can you discern the path of the future, what the market might offer, what kind of environment we would be operating in if you can't count on, at minimum, a country making decisions that are in its own interests?
right,
We're an absolute return fund, and we're absolutists by nature. And by that I mean, think about like how much trouble investors got into when interest rates were near the zero bound during zero interest rate policy, right? The people were
right,
still buying those bonds, and the closer a yield gets to zero, the more it literally represents reward-free risk. You are getting
right,
literally no reward for the risk that you're taking.
right,
And
right,
when rates corrected, you had people who had been buying very highly rated, high credit, double, triple A corporate bonds who were looking at 20, 30% losses on those in mark to
right,
market because they didn't understand the duration risk. And of course, solid credits, they're going to get 100 cents on the dollar, but how long are they going to have to wait for that now that they're 20 or 30% underwater in a solid credit? I think that a relative mindset, taking a relative approach to investing is it's very tricky. I think it's potentially pretty perilous. I mean, I swimming across a lagoon full of sharks may be less dangerous than trying to swim across a lagoon full of crocodiles.
right.
But the
But
fact
I
that
think
it's
you're right. I mean, you
relatively
mentioned,
safer is irrelevant to me. I'm going to avoid putting a toe in the water, period. And I think that investors, again, the environment that we're in and that we're going into should be careful about being seduced by relatively attractive returns when fundamentally they're not being compensated for the actual underlying risk they're taking,
right.
regardless of how attractive it is relative to other things.
I mean, you earlier said CDs, right? Short term. What's your long-term view on yields? Do you expect a higher yield environment for longer? The reverse of what we saw after the great financial crisis, where we had very low yields.
Well, I mean, if the Japanese have been manhandling the yield curve very successfully for a very long time,
Right,
and theoretically that could happen in the U.S. I mean, why wouldn't our debt to GDP go to 200%?
right,
The Fed and the Treasury could step into the market. I mean, it's funny if you think about it. Following the great financial crisis, basically Bernanke was sort of putting his thumb on the scale with respect to interest rates. And then when things
Yeah.
got really out of control with COVID, basically the Fed came in and stood on the scale with both feet. And
Right, right, right.
they basically forced the market, because these are the benchmark securities for risk across the market, they forced the market to misprice risk. And
Yeah.
that's where we still are. If the yields are not free trading, if interest rates, if those securities are not trading where the market would have them trade because the government is intervening, then they are mispricing the risk that the market would otherwise assign.
Right.
And
You
so,
almost have to expect a more synchronization between monetary and fiscal policy going forward, right? So I think
and
the
what are the odds of
role of
that?
Scott Bessent, which I think is a brilliant manager, and what he's doing right now, it's actually what's needed to be done because it's not his policy making that he's dealing with, right? But his role will become, I think, much more important going forward next to the Fed chair role, of course.
I never doubted that Ben Bernanke would risk destroying the dollar in order to save the economy. And I expect that going forward from anyone who's sitting at the head of the Treasury or the head of the Federal Reserve.
Right.
And so I don't think that things are suddenly going to fall apart tomorrow. I just think it's going to become harder to maintain the fidelity of a fiat currency as the fiscal structure that supports it continues to deteriorate.
Yeah, I agree. And then we can be glad we have people, scholars of history, sitting there in those shares, right? I mean, Mario Draghi in Europe was another example during the Euro crisis, right? I mean, these are really important institutions we forget, and most
Yes.
more important than the governments, in fact, right?
And it's also, I mean, I think that in a lot of ways, criticizing the Fed for not raising rates or lowering rates quickly enough is, to me, it strikes me as kind of childish and maybe a little deliberately naive in that, if you give somebody an impossible job, don't expect them to
Yeah.
do it perfectly. There's nothing more illogical or foolish than asking somebody to do something impossible and expecting them to do it perfectly.
Well, my thesis is this part of this, even not the most important part of the Fed is setting rates, right? I mean, you could do that through AI and in a very, non-political way. You just say what is the right rate for the current environment, and you do all the calculations, and you come to a point, right? I mean, we give too much importance to that question, and it's dominating headlines for no good reason, in fact. And if you follow that, I think you're going to end up really being a bad investor, unless you maybe fixed income investor. Of course, you have to follow that kind of narrative very closely. But for equities, I feel sometimes we shouldn't pay too much attention to the next Fed move, right? Because it's
Yeah,
short.
yeah. Absolutely not. I mean, certainly if you have the right timeline, if you're looking at the long term, which is what you should be focused on. I also think another point that's salient to the topic that comes to mind is, just fundamentally the lengths to which the government will go to avoid catastrophe. I remember, I mean, Meredith Whitney, when she called the collapse of the municipal debt market and what was going on there,
Right,
she wasn't wrong about the deteriorating fundamentals and what was happening there. The issue was she, I think, underestimated the degree to which the US government would go to avoid having that financial bomb explode. Municipal debt is a $4 trillion market. It is literally the plumbing to our economy, these local governments. The US government logically would do everything it possibly could to
right,
prevent that market from collapsing. Nobody had, any idea, had discussed anything along the lines of the Build America bonds that were
right.
introduced under the Obama administration to backstop those municipal bonds. But they came up with them because the alternative was watching that critical financial plumbing implode. And they were not going to do that. The government and the market is always going to try to find a solution, some solution, when it faces that magnitude of a problem. And so we always
Yeah.
have to keep in mind that whatever we're talking about, there may even, no matter how bad it gets, there's probably some solution they're going to come up with because they're not going to step back and say, you know what, just let it blow up.
Right. I mean, do you see that now with private credit, where people get very anxious around? And I say, look, this is an asset class that's pretty solid by definition, by structure, because you can't just redeem quickly. And it's now showing, we do 5% every quarter, and we keep that stable over longer periods of time, right? It's not
Yeah.
a bank run in a traditional sense where you get from a liquidity into a cash situation. So I think, sometimes the news have a way of hyper focusing on one topic. That's not really the problem. And the problem sits probably in completely different areas than private credit in this case.
Or the Strait of Hormuz, which nobody was talking about 6 months ago, and then all of a
Right.
sudden, I mean, you remember when you had tanks in the streets in Istanbul, and people were talking about Turkey going to fall. Nobody was talking. I didn't read a single article about the
Yes.
political fragility of Turkey and the possibility of Erdogan being overthrown. There's so many. I mean, a lot of people. Another example. A lot of people I really respect, very intelligent, successful investors, talk about how when you fully monetize your debt, is when a government that is issuing debt winds up being the only buyer of the debt, that's the death knell.
Right.
That's when you enter that sort of liquidity spiral and the whole economy and the currency collapse. The Japanese, basically the big banks, the large participants in that market, a long time ago, they backed away from buying government bonds. They have not been active participants. For a long time now, the primary buyer of Japanese government bonds has been the Japanese government. They've been selling them to themselves for a very long time. Now, that was supposed to be the ultimate trigger to an unavoidable collapse. And
Right.
they quietly have just continued to do it.
Yeah, and I remember I was sitting on a pension fund committee during the European crisis, debt crisis, and they tried to force us from the bank side to go 100% in fixed income, in sovereign fixed income, and this is madness. You can't do that. So you're much safer with equities in that situation, because there's the wrong perception sometimes we have around asset classes, and it's clearly the case often with fixed income is underestimated in terms of the risk behind that, right? And in certain pockets of it, I don't say it's in general, but and it always leads you back to the oldest recommendation, right, which is diversification. And of course, your strategy is looking for value. And so beyond that philosophy, every investor, watching this now is likely asking one fundamental question. They see all these things that we discussed today, and then they see also a valuation gap between US giants and with the rest of the world, right? We saw a shift into European equities, for example, last year. So tailoring your responses to the person sitting at home or in an office today, what do I do with my money now? How should, you mentioned the CDs, how should an investor contend with these recent developments we are seeing that you called very radical?
Well, in the US CDs, short-term securities, government securities, I would have the same point of view overseas as well. Obviously, there are disparities in those markets, and we don't have enough time to get into those. But preservation of capital, capturing yield at the short end of the curve, and I mean, one of the big advantages, another big advantage that the individual investor has is that they don't have to invest thematically. If you
Yeah,
look, the investment business has been institutionalized, right? And it's not the investing has been almost entirely eclipsed at the institutional level
yeah,
by allocating. Well, you want to invest here, you want 18% in the S&P 500 ETF and 15% in international stock ETFs. Um, just because you're investing in a vehicle that provides diversified exposure doesn't mean you're not taking on enormous risk. If that doesn't seem to make sense, consider an investor who bought very diversified exposure to Japanese stocks in 1989. That
Right.
Nikkei 225 ETF is down 30 for is underwater for 30 years. 30 years.
I never understand. I mean,
So,
it's a marketing thing by the asset management industry to come up with
uh,
these themes, right?
yeah,
Because
I
it's
mean,
for building new products and ETFs and so on. But
because
then
well,
ultimately, I
because
say it's fine if you have a pocket and you want to
yeah.
be a bit more risky. You go, okay, I believe in robotics, whatever it is. I allocate some capital into that. That's fine. But then ultimately, what I think I do personally with my portfolio is always run a factor analysis across everything and look for overlaps because some of these thematic funds they then invest in the same thing. I'm already in a single stock exposure, and you don't want to get overexposure, right, from these things. And most people don't do that. Also in wealth management, you get a mosaic of different investments without, running across like what's your overall factor exposure here, right?
Well, they're just looking to automate the investment process. And the way you do
Right.
that is just by using a model that comes up with different themes and exposures based for your age and your net worth and that sort of thing. But the thing is, because there are very few people or entities left that are actually investing and looking through to where risk actually resides, which at the individual security level, there
Right.
are lots of opportunities to find those investments because people are
Right.
not doing the analysis. I don't think that there's ever been a time where you've had more money invested in a way that people not only they not know what they're invested in, but they have no idea what it's worth.
Right.
And
Yeah.
and if that's the case, I mean that all of this money flowing into the S&P 500 ETFs, all of these big index-based ETFs, that does not make the market more efficient. That's blind allocation. They are just buying something based on an index. And that means that it should be easier, not harder, to find individual opportunities that are mispriced. And I think you can. I think that investors who are careful and rigorous and willing to do the work on individual names, in many respects, there's never been a better time for that because so much money is flowing into the market without even considering those factors.
Right. Yeah, and ultimately, I mean, we have indicators, of course, that can show us how much beta is in a portfolio and how much alpha is in a portfolio. And I would ask that question very critically to my financial advisor or to the asset manager, right? What are you actually be paid for here, right? Ultimately, you are supposed to generate alpha and not beta because I can get that cheaper through other means. And I feel that there's a level of missing education here in the market sometimes because you don't get these critical questions. They're very
And for
superficial.
the investors who are watching, again, the retail individual investors, particularly if they're at the later end of the demographic scale, if approaching retirement or in retirement, I don't think there could be a better time to play defense. Particularly if you are in a position where you've earned a fair amount, you've been able to set aside a fair amount for retirement, protect it. Take the
Cash
win.
and gold. Cash is
Take
king.
take the win. Invest in safe securities that pay a modest yield. Don't worry about where they trade relative to something else.
Right.
Play it safe, protect the money, prioritize the preservation of capital above everything else.
And you're saying that specifically now, or you would say that 20 years ago you would have said the same to someone who's short, because that's ultimately advice we give to, soon to be retired people, right? Move into fixed income, move away from equities.
You're right. When they're entering, I guess, the decumulation
Right,
phase of their
right,
investment life. But yeah, so you're right to point that out. I mean, that is, based on age, but I think also right now, a
right.
lot of I see a lot of older investors who are just taking on more risk than they should because they've been sort of seduced by this long period of gains in the equity markets and where
Yeah.
there'll be some really sharp sell-offs, but they correct. And so they're looking in the rearview mirror and saying, based on the rearview mirror, the picture ahead looks fine. And I think that's a particularly dangerous mindset right now.
Well, that's an intellectual also mistake, I think, by saying things like, okay, we just had our last recession, what, 3 years ago, 4 years ago with COVID, right? That wasn't a
Mhm.
recession. That was an extraordinary, very short-lived event. And so the real last one was 2008, in fact, right? And so it's been a very
Yes.
long period. And we look at the charts, the S&P 500, say, wow, it's like things are only going up, up, up. So let's take that as a historic evidence from what's going on happen in the future. And I think, yeah, I'm spot on. But the problem then always comes like, is this happening in 1 year, 2 year, or in 5 years, right? Or you miss a train by now going too much into cash and overreacting.
Well, I mean, the closer you are to retirement or the further into retirement you are, the more you should be willing to miss that train.
Right, right. And you mentioned earlier, uh, you mentioned Berkshire Hathaway and as a benchmark, almost prioritizing, let's say, character and ethics almost as much as numbers, right? Quality is not only quantity. And this is, I think, a refreshing contrast to what we hear from the Wall Street echo chamber. I was saying, oh, Warren Buffett, that's outdated. That's yesterday. You can't apply that. What is the one trait you look for in a management team when you look at entities that the typical analyst completely ignores, you think?
I was thinking about that, and I understand why somebody watching us would want there to be a very specific answer to that question. Uh, but if I'm going to respond with humility and honesty, I think the answer is there isn't. I think that the typical analyst, if they're making an effort to be rigorous, is probably looking at all the right things. What perhaps sets us apart and explains some of our success is the geologic pressure that we exert on the process. I mean, I've been doing this a long time. I bought my first stock when I was 13, and I have a pretty good idea if I'm, onto a potentially good investment at this point after maybe only 20 or 30 hours of analysis. What distinguishes us and explains, again, a lot of our performance and our record for capital preservation is I'll spend the next 200 hours trying to confirm that we're not wrong.
Right.
So I don't think the typical analyst completely ignores anything. I think it's how much pressure they're willing to exert, how much research they're willing to do. I mean, I don't think you know a
Yeah.
company if you haven't read the last 10 annual reports. And that, if you add that time up, that takes a while. And what about the competition? If you do all this stuff that seems very, very logical, pretty soon you've spent a lot of time. But that research also leads to other investment ideas and insights as well. So it's generative in a way that I think people underestimate.
Well, there's actually research around that underpins what you just said, right? I mean, the amount of work that goes into this, but you can measure it, in fact, because you can see when fund managers access these filings, and researchers have measured it against performance, and they see a correlation there, right? And it often comes also during periods of underperformance that they then become much more active in terms of their research, and after a few months, it return. I mean, it turns around. So it's fascinating to see that alpha is linked to research. It's not something that is luck or it's just following the benchmark. So it's really fascinating actually to look at that.
Another factor I think that's really important that is kind of central to our approach is that, I mean, you have to be really willing to not invest regardless of how much work you've done. I mean, I don't expect because we find something that looks interesting that the price is also going to be appealing, just happen to be attractive at the time that we start looking at it. So
Right.
we've had, I've had positions in the portfolio. I have some in now where, I mean, I followed a company for 10 or 20 years before pulling the trigger. And because you decide what price compensates you for the risk, and then you
Right.
wait for that price. And I don't know, to some extent, I sometimes wonder whether our return could be higher if I weren't quite so rigid. And we do adjust those numbers over time. We'll raise it as we see things improving, what we're willing to pay. But we're pretty, we're pretty inflexible about holding out for that price that offers an irresistible risk reward.
Right.
And that's happened. I mean, we literally I sold it. I have a position in the portfolio. It's a company we followed for over 20 years.
Right. I mean, yeah, then you go through different business cycles, right? And then companies age and there's innovation and so forth. So and you take that obviously into account when you look at those things
But
and then
we also, and it's another important thing, I think that you talk about the lost art and different ideas that are no longer in vogue. Um, we're absolutists when it comes to risk as well. I mean, we
right,
view risk in terms of financial loss, not transient superficial price volatility. We don't, the price from day to day doesn't tell us anything about the financial risk we're taking. And in turn, that's why, I think our capital preservation has been so strong because we look
right,
through what is the actual source of financial risk.
right. And then in terms of research, you obviously have to make sure you have a global view, right? I mean, I sometimes see it myself. I use a lot of seeking alpha as an input, and that's very US centric. And then I have to go to other sources to find out what's going on in the Czech Republic or other places because they're also stock markets with interesting value plays, right?
Oh yeah, no, no. I mean, we've got exposure in Europe, Northern Europe, Africa, South America, Japan. I mean, we've got exposure all over the world. Um, we'll we will go anywhere we feel like we can get sufficient information to make a fully informed, intelligent decision.
Right. And you feel you can do that on a fact basis. You don't need to go further and have one-to-one meetings with CEOs. You just simply look at the results and their earning calls and so forth.
Yeah, for the most part, every once in a while we'll communicate with the company, but generally speaking, we just make our decisions based on the available information.
Okay.
I got my start. I studied under Jim Rogers when I was doing in grad school at Columbia, and I don't want to get it wrong. He used to say, I mean, um, if you want to get that like the answer that's half right, talk to the CEO, and if you want to be get the answer that's completely wrong, talk to the chairman.
Right, right.
I don't know. I have talked to a fair number of people who are in management, CEOs and CFOs and that sort of thing, and I have yet to have a CEO, going up to them, let's say after a presentation at a meeting, come up to me and say, to be honest, Steve, I think we're doomed.
Yeah, that's the thing. It's like I like to listen more to CFOs personally because I think there's a bias as a CEO selling more of the company story and narrative, where the CFO is like he's bound to the numbers or she, and but I don't know. It's the right mix, I guess, of input data you have to absorb, and there are investors apparently using that AI to listen into earning calls and see if this is an honest reply or it's basically marketing, right? I don't know whether that works or not. I think it's an interesting data point, perhaps, but not.
Well, there's probably a logical threshold in terms of the amount of information that you get where you can't really process or weigh it anymore. But I
Right,
think more information is better. I mean, I have nothing against, for example, non-GAAP financial reporting. I think when you're looking at companies, being able to compare the GAAP and the non-GAAP can tell you a lot about what's going on under the hood. And if you think about it, I mean, you've got the financial reports, the financial statements, the income statement, cash flow statement, the balance sheet. Those are effectively an interpretation of what's actually going on financially and economically
right.
underneath in the company. And then you've got your interpretation of that interpretation.
Yeah.
So you have to always, there's so much that's happening that you don't have a direct picture of. I think more information in many ways is always better. We
See,
are
I also read about what my favorites are short reports, and I had a couple of cases where these short reports actually gave me an insight I didn't have, and I divested from that entity, and it usually had to do with trust issues and not being honest, and in one case it was in fact fraud that you would not see in just the numbers, right? Because the
yeah.
report doesn't show that, and so I love hedge funds in general because they obviously also do short reports often, and that's a great source of information.
And again, the individual investors who are watching this, the advantage to another advantage to running a concentrated portfolio is all of the things you can avoid.
Right.
You don't need to find 50 great investment opportunities. You can find a lot less. And anytime you're involved in a situation or you're looking at something and thinking, well, this doesn't seem quite right, then walk away.
Right. You said 15 to 20 in your portfolio, is that right? Or
Yeah,
yeah.
I don't know how well that fits with an investor who doesn't have our research capacity, but I think that everything that I do could be replicated by somebody with a basic understanding of financial reporting. I don't think there's anything that, there is no real secret sauce here. And I am, I am not an investment genius. It is just purely adherence to a process that is very rigorous that generates the returns that we're creating.
Isn't that also a mathematical thing? Like if I have junior miners, for example, right? They're so small in market cap, then it would make sense probably to take 100 of those because it's like venture capital. There's a big chance that 95 of those will not be successful, or five will be super 10, 20 beggars, right? Whereas then if your strategy is to invest in blue chips, then you might end up just 10 because this is where you did your research. Isn't that
Yeah. In
a
the
fact?
former, what you were just describing is basically what's known as spray and pray, right? And
Right.
you're gonna have those outliers that they offset. It's the venture capital approach. The outliers that succeed are going to offset the losses in everything else. And I think that as long as you're willing to own enough companies that you're going to capture those outliers that offset the losses you know that you're going to take, well, then that can work. And I mean, it raises another important point, right? Every investor should be pursuing a process that works for them and
Right.
their skill set and their mentality, their emotional profile, how patient are they willing to be, how much are they impacted by volatility. A lot of people have trouble with the detachment necessary to be able to invest over the long term, and they should frankly have their capital managed by somebody else who isn't so disposed.
Right. Well, lots of very interesting things to cover here, and I think this has been a really great discussion today. Your approach is, I think, a necessary corrective to surface level thinking that we often see in the market, and it's been really an inspiration for us to talk to you. And I look forward actually to our next talk, Stephen. To our audience, thank you for your time. We will be back with our next session shortly.
Thanks very much, Henning. I really enjoyed it. I appreciate the time.